Everyone, this is Tim Picciott, the Liberty Advisor, along with John Sneisen, the Economic Truth. And today we are here for, it's actually, this is still part of episode 6, but what we're doing is we're taking these live shows, and then and today, for instance, we're going to chop it up into 2. So this is report number 2. And today we're going to talk about a problem that I actually think is bigger than the stock market problem, and that is the bond market problem. And then you get into what's the biggest probably segment of the bond market that's in trouble, and that would be collateralized debt. And then you get into what's probably the worst of the collateralized debt, and that's probably the energy company bonds, because
shale in particular.
yeah, in particular. So it's like one of these like little Russian dolls that we open one up, and we're just getting a worse and worse and worse and worse, as we're getting into here. And so I've got an article right now from Barron's, and it says high yield bonds are sinking as bankruptcy fears hit the oil patch. And what we're seeing is the riskiest shale oil drillers and pipeline companies could be entering a vicious cycle of investor losses amid rising borrowing costs. And so junk-rated bonds of U.S. oil and gas drillers were already tanking before oil prices expectedly dove over the weekend, thanks to a surprise war between Saudi Arabia and Russia. They looked set for even larger losses on Monday as oil prices fell about 20%. And then we see, there's different ETFs were down 4.5%. You had I can't really name these because I am a financial advisor, and so I do. So if I name what these are, then I've all sorts of disclaimers. Go find your own advisor. If you don't like them or you don't know their name, then you can come, potentially work with us over here. But as we were getting ready to go live, I just happened to go to Zero Hedge. Not happen. I mean, I go there, 9 million times a day. But what I was looking at is the levered oil apocalypse. 2-3 times levered oil exchange traded funds to liquidate. So, I mean, this is news. I'm literally reading it right now for the first time because we're just about to go online. And it says, in the aftermath of the February 2018 Volmageddon, aka VIX terminations, I called it the I forgot what it was, the Voxopolis, which funny because the week before that event happened, I was on Ernest Hancock's show. He goes, Tim, what's the worst thing somebody could do right now to invest? And I said to short the VIX, and literally a week and a half later, you had multiple indexes, VIX indexes, that blew up and terminated. And so right now, the lucky people today are the Wisdom Tree Brent crude oil 3 times daily leverage, and the Wisdom Tree WTI crude oil 3 times daily leverage products will both be terminated due to an extreme adverse move in oil futures. So these funds had a combined $10.3 million in assets. They relied on...
Hey, the Fed needs to buy them, Tim. Come on. Go Japan. Go kamikaze on the markets.
Yeah, I mean, that must be the only problem, is that we need the Fed to come in here and buy all this stuff. But yeah, we've got people who've got early termination notices, aka, thanks for playing. And this is what happens when you're going out on a margin. This is what happens when you start doing risky things. We've got another article here from the Greenwich Times, and it says fears of corporate debt bomb grow as coronavirus outbreak worsens. And so a lot of these companies already were on precarious grounds to begin with. You've got, there's over 10, so the coronavirus panic could threaten a $10 trillion mountain of corporate debt, unleashing a cycle of layoffs and business spending cuts that would hit the economy just as analysts are warning of a recession. So this was we said it before, this was a bubble looking for a pin, and this was a gigantic bubble that was going to burst, absent this. And so even with these record low rates, even with the Fed doing everything they can to step in, even with the plunge protection team helping out. So if you guys are watching this as a report, we just did a video on the plunge protection team that you guys can go check out. But, this is, to me, is the big enchilada, is the corporate debt market, and in particular, the energy market bonds. And I just want to see what your thoughts are on that, John.
No, it's Tim. What's happening here is, of course, and this has been a problem all along. The shale, the possibility of shale oil was created by cheap debt in the first place, and now, of course, the debt has been cheaper and cheaper. But the problem is they levered and levered up. But now the oil is so cheap as well, so it's not workable anymore, because basically shale oil is anywhere from $60 to $90. I don't know the exact numbers offhand, but it's now at about 30 to be 32 or something, the BTI. So what you're looking at is basically at least 50% below cost for a lot of these guys. And if you believe that that's sustainable to be able to hold on for a long time, and especially with them that are levered up and don't have a lot of profits, because their profits was made possible just by borrowing a whole bunch of money, you're seeing that they're really starting to struggle. And of course, Tim, You've got countries like Norway, where we have offshore oil, 100% offshore oil, where it's $60, and so there you also are seeing heavy issues today. They're going to bail out everybody in Norway, basically the government, and they had 9.5% drop in the stock market, and then of course here in Canada we got the oil sands, which is just tar sand oil, which is super hard to extract, takes a lot of energy and a lot of cost, and so that takes about I think almost as high as $90, and we are like hovering around 20 something dollars per barrel for that. So you're seeing the massive sustainability here, and for those companies that were levered up here and have all that debt, they have so much risk on their books. Tim, being in Norway or being wherever it is in an oil country right now, when you have those massive shocks and you're heavy over leveraged, but not on top of that, it's just ridiculous. Like you're leveraged and you basically are producing a product that takes more, that costs more than you actually are able to sell it for a very long time. And but cheap debt, they racked up on all this debt, Tim. These corporations that are now starting to really look at potential bankruptcies here, and so that's where and who knows, maybe their debt was also put into CLOs, so maybe you have some CLOs that are in the oil fields or whatever you call them, and those are going to blow up here if that's the case, Tim, because these companies were not supposed to be there in the first place, but they were made possible by dirt cheap fiat currency that been close to zero in interest rates for the big guys. So it's not it's not a thing that should happen, and a lot of the oil industry is super unsustainable because of that, Tim. Except for Saudi Arabia, it's like $5 to suck out oil, or $18 for onshore Russian oil. So of course, there are those, and mostly in the Arab Peninsula, of course, they're cheap oil, and then there's other cheap oil in Kazakhstan and so on. But other than that, a lot of these hard to get to oil, and that's for Venezuela as well, of course, and a whole bunch of others. It's not sustainable, especially when the price drops like this, and that was of course twofold. It was the coronavirus. You get a huge drop off in traffic, being airline, being transportation of goods and services, and of course people driving in itself. So you get a lot of hit there, of course. This is getting to very dangerous times here, and of course talking about all the $10 trillion of other corporate debt that is out there, that is in 2018, all of the non-financial corporate debt that was issued, it was 78 point something percent that was rated junk. So it's such an unsustainable bubble there, Tim, with both, especially in the resources, not in the oil sector because of the oil price shock, but then also in the corporate sector itself. There's so much rotten debt, and doing share buybacks and all this garbage to prop themselves up. It's not becoming sustainable anymore because share prices are plummeting so much that you can't keep propping it up like this anymore.
Yeah, and I think another important point to make when you make about the junk bonds is that you have half of the investment grade bonds are one notch away from junk. So over half of the half of the investment grade bonds are triple B, which is one step away from junk. And then usually when you go into a recession, I forgot what the exact number was, but I mean I think it works out to like $800 billion worth of loans could be in that default, which then because of ETFs now, ever since so many people are in exchange traded funds, and I use exchange traded funds for my client, not saying that they're bad, but what it does is it then amplifies all these moves, because as people are just selling the ETFs indiscriminately, they're not taking a look at actual companies, and the selling begets more and more selling, and so you're seeing all these crazy moves. And I was just looking in our comments right now, so I want to say what's up to Chris. Super hard last name to pronounce. Zizapansky, I don't know. So no, different Chris that starts with a K. So I want to say what's up to him. Thank you for the comments live. But yeah, he's commenting about what an insane day in the Dow. plus 1,200, minus 200, plus 1,000. It's insane, and it was insane because I remember seeing it opened up,
Yeah.
limit up, and I think Zafoy just wrote haha, so he's in the Discord right now. And what I want to say is, guys, if you guys are financial economic geeks, you definitely want to check out our Discord, especially in the general area. I mean, we just have so much, firepower that's in there that's amazing, and it's something new that we just started. Actually, I think right at the beginning of the year. So pre coronavirus, we got this baby kicked off and rolling, and then I went to Anarchapulco, then came back, and the whole world's on fire, and so never really had. Well, I guess the world was on fire to start the year with Australia. So, but anyways, you guys got the link. You do have to type it in exactly, so all lowercase Tim John Discord. So it's bit.ly/Tim John Discord. And so that did trip me up yesterday because I went to go put in, I don't think like it was capitalized or something. It wouldn't work for me. So just make sure it's all lowercase, and you guys can find us there, especially if you're in the financial markets and you're watching this on a whim. Definitely want to check us out. But anyways, I think that kind of wraps it up for, what we wanted to talk about in terms of, what's going on in the oil markets, because I think the bigger story, because people aren't really talking about the oil bonds. They're talking about the oil stocks, but to me, the oil bonds are even a bigger issue.
The debt, exactly.
And the debt, in general, the debt is just a bigger issue. But, we'll wrap this up and we'll stick around for a little bit for some Q&A. But anyways, thank you guys. I almost said thank you guys for playing, but no, thank you guys for listening. Definitely appreciate it. This was streaming live on Tim Picciott, the LibertyAdvisor channel, because time to time there's different videos that Josh does, and we can't mess up algorithms. So if you guys want to, whereas I don't really care about the algorithms because I don't have very many people following me. So if you guys want to go check me out, that would definitely be awesome. And where can people find you, John?
They can find me on theeconomictruth.org or The Economic Truth on Facebook. Or they can find me, actually, I think we're going to set up next time, Tim, so we're going to stream from my YouTube channel that I have as well. So we'll get that going as well, Tim. Just go to theeconomictruth.org or go to our Discord. You'll find me and see what kind of shenanigans I'm up to.
Yeah, we'll see what times of shenanigans he's up to. Anyways, for now, it's Tim Picciott and John Sneisen saying farewell, and talk to you guys later.